We thought that breakout in November, by the way, on these spread charts, relative performance, is our final buy signal for gold now and
Hmm.
silver and the miners. We put out long-term buy signals in 2024,
Hmm.
March, April of 2024. At that point, silver, for example, was pushing up toward 26. Okay. Uh, and the golds and miners were much lower levels than they are now. We put out another buy signal in June of 25.
Hmm.
And we're talking silver, especially here. And November of last year was our final major last point of entry. Okay. So if you're joining now, you're late. We're not going to offer major entry points now. We'll offer short term entry points. But the big signals have already been rendered, this being the
Hmm.
last one that you're looking at there. So the issue is okay, what are we expecting out of this big shift?
Yeah.
And we're expecting a explosive acceleration move in the whole complex. What this is, if you think about this, if you're an investor, you should not be thinking about what's going to happen the next 3 months or 6 months. I mean, if you're a trader, yes, okay. In which case you could flip flop all year long. 3 month surge, 3 month sell off. You don't care about the major trend. But if you care about an investment grade trend, something you can maybe buy and hold for the next couple of years, then you should be looking at big picture stuff, not the day-to-day headlines. Okay.
Hmm.
Uh, what these charts show is simple. It shows gold miners, and silver plotted in their relationship to the valuation comparison to the S&P 500. And these charts go back to 2008. And as you can see on the left side of each of these charts, its high levels were reached in 2008 through 11. And that's when gold peaked. Remember, in that price, it peaked in late 2011. So did its spread relationship to the S&P. So did silver. So did the gold miners versus the S&P. They not only dropped in net price, but they dropped in relative value to the S&P. Okay.
Right.
So the spreads collapsed. Okay. And the spreads collapsed down through 2015 and even a little bit lower, a little later, uh, as the market themselves dropped. Gold miners, silver. Okay. But then over the last, like 10 years, these charts effectively went sideways, meaning they were holding their value. Whereas if you randomly bought gold miners or gold or silver, like say 8, 9, 10 years ago, where these spreads are right now, you're actually making money
Yeah.
versus the stock market. Nobody
Right.
believes that, but you've been actually been making money and holding your own all during that time. Meaning, as the stock market advanced, so did gold and silver.
Hmm.
So they weren't really a worse place to be. They didn't have any headlines. Stock
Hmm.
market always has the headlines. But from a long-term investment point of view, these charts are all echoing the same statement. They're saying, hey, we're now beating monetary metals and the miners thereof are beating the stock market. And this is a fresh major base breakout in all three cases. Their
Hmm.
performance just shifted back in November. So
Yep.
when you have a base that's more than 10 years wide, let's say this is a price chart, and somebody flipped it on your desk and said, should I buy this? You say, heck yes, that's a fresh breakout. So what these
Hmm.
spread charts are all saying is one, I built a major base that said I'm not going any lower. Step one. Step two, the base is huge, it's clear, it's definable. You just broke out in November. These Jan, Feb, March are 4 months old, and the spread is not that far off the breakout level. Far
Hmm.
enough to be noticeable, but still, it's not overdone. It's not aged. There's nothing about these charts that says anything but buy me
Yeah.
relative to the stock market. And it just began. It's just the opposite of what happened back in 2008 through 11. You could see the spreads were topping.
Hmm.
And anyway, so now we've bottomed freshly. This thing's going up. These markets are going to beat the stock market over the next several years.
Right.
And it just
Yeah.
began. So it's not overheated like everybody claims. And now look at the drop you see on each of those charts. That's where we were as of Friday. Okay.
Hmm.
Gold versus S&P, gold miners versus S&P, silver versus S&P. Hardly noticeable. Not
Yeah.
the kind of drop that would say this chart is negated. No, it's just a little hiccup. We thought that breakout in November, by the way, on these spread charts, relative performance, is our final buy signal for gold now and
Hmm.
silver and the miners. We put out long-term buy signals in 2024,
Hmm.
April, March, April of 2024. At that point, silver, for example, was pushing up toward 26. Okay. Uh, and the gold and miners were much lower levels than they are now. We put out another buy signal in June of 25,
Hmm.
and we're talking silver especially here. And November of last year was our final major last point of entry. Okay. So if you're joining now, you're late. We're not going to offer major entry points now. We'll offer short-term entry points, but the big signals have already been rendered, this being
Hmm.
the last one that you're looking at there. So the issue is, okay, what are we expecting out of this big shift?
Yeah,
And we're expecting a explosive acceleration move in the whole complex.
I
But
agree.
we've been arguing all along that somewhere in the middle of this clock, and we think the clock is like a couple quarters, meaning starting December, so early summer, let's say. Much of the dramatic part of the price move should occur. It happened sooner than we thought. We thought there would be a midpoint correction. Therefore, we were kind of thinking maybe April. Instead, it
Hmm.
happened the end of January. So
Hmm.
we're fooled, yes. But we still regard this when we look at our long-term momentum charts and even these spread charts. There's nothing being broken here. You're just
Yeah,
having a sharp sell-off.
right.
And therefore, it's a sell-off within an uptrend. And it's a buying opportunity for those who didn't buy at our buy points. Like if
Yep.
you average our last three buy points in silver, the average price of those 3 points of entry was $36 an ounce.
Hmm.
Okay,
Right.
so we're trading 72 as we speak. Okay, so well, should I be crying? Okay, I don't know. Anyway, we think that what you saw at the end of January, by the way, which took a day and a half, it was
Right.
really one day, January 30th, and a half a day on the opening of February. Almost all the break had occurred by then.
Yep.
And last week we went down and nipped out those two lows, the low on gold that had occurred then and the low on silver that had occurred then. We stayed below those lows for 2 hours since early last week and then said whoosh, right back above them and said, I don't belong down there. Okay. That was the final cleansing poke. Okay. I think we're now in the process of resuming the upside. There's
Yep.
a point at which, like you said, we've dumped a lot of people here. And
Hmm.
that's fine because a lot of these people were late comers. They didn't buy at $36 silver or $25 silver or uh, where silver was in November when it broke out on this spread versus the S&P and also versus gold it did. Silver was then 56. Okay.
Hmm.
So this move, this jiggle we're seeing is what we think is middle of the clock, basically, of what we thought would take 2 quarters. Okay, December, January, February. Okay, now we're in March. Okay, April, May. I think by summer, if we see this short-term turn up that we're seeing right now continue just a little bit more, we're going to get some breakouts on short-term stuff that say, yep, going back up again. If this break had broken something on long-term momentum of silver, gold, or the miners, we'd be bearish.
Right.
We turned bearish on gold 2 months after its high in 2011 and stayed bearish till 2016, February of 2016, because
Hmm.
long-term momentum had broken. Right now, this break in gold and silver that we had didn't break any long-term metrics.
Right.
It broke short-term stuff. Yeah, you can
Sure.
always do that, but then those can heal quickly.
Hmm.
But anyway, this is within the complex. Silver versus gold is the top left chart, and this is the one we're mainly focused on. Silver is very cheap in relation to gold. It's a little bit more than 1% of the value of gold there, or 1.5%, excuse me. Uh, and we think it's going to go to 3 to 6%. It's like look at the 2011 high on that chart there. It got up over 3%. Divide an ounce of silver into an ounce of gold, it was 3% plus. Right now we're above one. It's still cheap versus gold. And it is a monetary metal.
Hmm.
Don't let thousands of years of history go by. It's a
Yeah.
monetary metal. And the same thing's going on with the miners, the XAU index versus gold down below and the Huey versus gold. They both broke out of relative performance situations too. So they're saying, hey, buy silver and buy the miners. Yes, gold is the mama, but we're going to outperform the mama market
Yep.
within the
Yeah.
complex. Now look at the gold chart below. Go to the next page. Just simple, stupid price chart. Okay. Well, we're higher than that right now. In fact, if you uh, factor in that we're rotating the June gold, then we're well above that last reading. But there's 3 months up there effectively stalled at the same price level. You get up to 53, 5,400. There was one spike above 55, but basically, at 3 months pounding the same level. Gold doesn't peak that way. If you go back to 2011, when you made your high in September, I think it was 2011, you dropped from 1900 down into like the 1500s. You never
Hmm.
came back anywhere close to the 1920 price high.
Hmm.
You came up into the 1700s again, but you couldn't get back up to the old high. Well, if
Hmm.
you internally look at gold on a daily chart, anybody who's watching this right now, go to your quote screen, punch up a daily continuation of gold. You'll see that the peak daily close back in late January was just above 5,300.
Hmm.
Early this month, we had a peak daily close just above 5,300. In other words, not only does monthly price chart go back up into that supposed thin air, but the daily price close went back up and effectively matched the peak close of January. In other words, the air is not as thin as you think up here. You shouldn't have been able to go back to the high again. We're saying now you go back to 5,300 gold again, they're going to blow your head off.
Yeah.
And for silver, we think the key level is getting back over 90 again. And we're talking price now, not
Yeah.
momentum will give you earlier signals. And those are in our reports. But for just a price chart guy, if you want to know when this quote correction is over with, which has really been a violent sideways consolidation if you look at it, you get back over 90 on silver and you get gold to 5,300. You better cover your shorts. uh, uh, or you're going to wet them because they're going to blow at that point. And
Yeah.
you're going to get the acceleration that we expected in this couple quarter surge. And consider what you saw in late January to be the midpoint correction, uh,
Got it.
time wise. I think silver could be $300 to $500.
That's
You
a
get back,
beautiful thing.
serious. Yes, no. And the factors in play are both the monetary aspect, because if during that same time we see those S&P charts, one, have a little bounce now, waste some of late March, early April, maybe a
Hmm.
couple weeks here, have a nice rally because the Iran thing abates or whatever. And then you roll back through those annual and quarterly structures we showed.
Hmm.
You're going to have a blood flow. And already some smart money's been moving into what? Not T-bonds,
Yep.
gold and
Gold,
silver.
gold
Yeah.
and silver.
Okay. You'll have a massive money flow out of that broken bubble into
Yeah.
gold and silver once it becomes a public awareness that, oh my gosh, it's really broken.
Yep.
And the central bank will go berserk. And we
You,
already know, the new Fed chair is going to go berserk. Watch, by the way, one thing we pointed out back in October, and since then we've updated and updated. Everybody's looking at AI. Yes, AI ultimately will lead the downside.
hmm.
The leader in the prior bull usually will lead the downside, mean suffer more.
Right.
But it's only been AI was only the leader in the last 3 years of that bull market, not since 2009, but only in the last couple of years has AI really been the leader. What you got to watch is financials. And we've been watching them and they've been bleeding badly. Not in a collapse. No, no, no. But badly technically, where those structures that we showed on S&P, like the quarterly momentum, they've already
Hmm.
blown those structures.
Hmm.
Some key banks have blown those structures.
And think about that.
Yeah,
That's,
that is what upsets the Fed more than anything.
yeah.
So, are they going to go berserk? You bet to you they are.